Now, let's talk about trading rules, trading systems, and how they're established. So this is very important because a lot of people have no clue how to approach that or how to work with that or how to interpret it or how to even rules given them by somebody else even have a chance of being successful. So here's the problem. A lot of people go and they just research stuff online or books or whatever, and somebody tells them, oh, you trade whatever. Let's take a very common one, moving average crossover. When this moving average crosses over that moving average, get a moving average crossover of two moving averages. Everyone has their favorite moving averages, whether it be SMA, EMA, all the weighted moving averages, whatever. That has no bearing on what the market is going to do. Okay, so right away I would look at any type of moving average crossover system and I would say that does not give you a statistical probability. There is no logic behind why the markets would go up or down just because a couple of moving averages crossed over. Now, one exception to that would be some that a lot of people are all trading. Let's say the 50 and the 200 moving averages. You get a golden cross or something like that. But the only logic behind why that works is because so many people are trading it and following it and know it. So it's a self-fulfilling prophecy. And that's fine. And that's good. That's a good reason. Mass psychology is one of the best reasons to trade anything. So that's okay. But others, just choose your moving average because it's based on a Fibonacci ratio or something ridiculous like that. Sorry, that has no logical consequences with regard to what the market is going to do in the future after you get in. So you try to explain it to me, you can't. And most people can't. So what they'll say is, oh, well, we use the moving average crossovers because we backtested them. Really? That's your logic? Okay, that's a horrible way to create a trading methodology. Because, well, I know now I'm getting into some very controversial territory. Wait a minute, backtesting is a bad way to create a trading system? Yep. It's a horrible way to create a trading system. Why? Well, the regulators have already answered the question. Every time you look at an ad or look at a financial website or whatever, you'll always see the little fine print down at the bottom, so small that you can only read it with microfiche, but it's there, and you know it's there, and you know this already. Past performance is not indicative of what? You fill in the blank. You know that sentence. You've seen it a billion gazillion times. And that's a very instructional sentence. That is not just there for legal purposes. I mean, it is there for regulatory purposes. But the regulators want to educate you. They want to keep you out of trouble. They're doing you a great service, by the way. That's one of the best trading educations you can have is to read through those disclaimers that you think are just legalese, and so you don't read it. Oh, read that stuff. That is there to protect you. It's not nonsense. It is really, really important. It's to counter the hype that is out there in all the advertisements and so forth. So you'll even see, and these are the craziest ads of all, the ones that say, oh, we've had all these, this performance over the last 2 years, 3 years, 5 years, whatever. And they know that the average consumer is going to look at that and they're going to say, oh, I want that fund manager or that system because it had this great success over the last year, 2, 3. But here's the problem. And they use those ads intentionally because they know that people will buy for that reason. Forgetting that even at the bottom of that very same ad, you will say past performance is not indicative of future results. And they got to put that, which contradicts the whole claim. And maybe the claim is not even wrong, but the assumption, and they know the consumer will assume that, oh, because it was successful in the past, it'll continue to be successful in the future. And that's not true at all. In fact, there's been studies that show the exact opposite, that funds or strategies that have outperformed the market in the past have underperformed in the future, and there's a reversion to the mean situation going on over the long term. And so they will actually be underperforming in the future, most likely. So it actually becomes not only a bad way, but a horrible way to create a trading methodology. So how do we create a trading methodology? What does it have to be built on? It has to be built on what's actually happening in the market now, bar by bar. We literally trade bar by bar. what's happening. And what's the core of all auction places? And that's what the markets are, by the way. I don't care if you're trading Forex, futures, commodities, options, stocks. They're all auction places. There's bids, there's asks. And the market price go up and down depending on how much supply or demand there is on either side. And so that's all that matters right now. Doesn't even matter what the news is, because sometimes markets go up on bad news and down on good news. It's all, what do people do? Where do they place their bets? Okay, what's the supply, the demand? Now, that will be triggered or stimulated by news and sentiment and articles that come out and all that kind of stuff. And yeah, so it matters in that way. But the bottom line is, you got to just watch what's happening in real time at that moment and then go with that flow. And if things change, if the current changes, you change with the current. Because old saying, market could do anything at any time. And that's very true. And that's why you've just got to lock into that, as I've talked about before, the money flow. It's kind of like surfing. Just go with the flow. Ride the waves of the market. Don't try to predict them. Don't try to outsmart them. You will not outsmart them. And they're more powerful than you or I as an individual. And so really the only answer is to develop a strategy and put it together based on following the supply-demand imbalance. And when there is no imbalance, then we don't trade. That's called a consolidating sideways market. And you have no edge. That's ridiculous to trade those. So we wait for a big imbalance, jump on board, keep watching in real time, day by day, bar by bar, minute by minute, if you're a day trader, until it shifts. And until it shifts, you keep riding it. You don't get out just because, oh, you're getting scared, or you think, oh, I made $50. Wowee. Who cares? You just keep going with the flow. And don't get in until there's a very, very clear signal that supply-demand has shifted. Until then, we do nothing. We do nothing. Just keep your powder dry. If you want one of my trades, it is a high probability trade, and it is based on mathematical statistical probabilities. Get my rubber band trade. That is a reversion to the mean mathematical model. Very simple. It takes me 26 minutes to teach you to. It's on a video, 26-minute video. So grab that for free. Start making some money before you pay any money. I don't charge any money for that trade setup at all. It's my gift to you. So go to rubberbandtrade.com and pick it up for yourself. In the meantime, share this video with other people if you liked it. Share good things with good people. Happy trades. And until next time, this is Barry Burns with Top Dog Trading.